Now I would like to discuss with you historic cost, which is a fundamental concept or convention, if you will, in accounting. And in most cases, we're talking about the use of what is called historic cost versus the recording of what we call fair market value or even fair value. In most cases, GAAP, as we know it today, Generally Accepted Accounting Principles, requires the use of historic cost accounting. The advantages of the use of historic cost as opposed to fair market value is that historic cost provides, and I'll read it for you, certainty, objectivity, measurability, universality, and the ease of application. Let me read those again. Historic cost has the advantages of certainty, objectivity, measurability, universality, and the ease of application. And it doesn't matter whether you're in the US and dealing with dollars or whether you're in France dealing with francs. Historic cost, wherever it is and in whatever language, if you will, has those advantages. There's little room for wiggle. There's little room for inaccuracy. You bought something, you wrote a check, or you paid cash. It's easy to measure. It's universal. It really is, and it's easy to apply. Because when you talk about fair market values and fair value or whatever, and we will talk about that a little bit more, so long as you have an open and free and unrestricted market, that's very helpful and very beneficial. You can probably figure out what you can sell your accounts receivable for. If your company has marketable securities, it's easy to come up with a value. You look in the newspaper and see what their stock is trading for. Or maybe you're buying inventory and it's easy to find out what the market value of it is. But there are a lot of assets and a lot of liabilities for which there are not markets. And what the accounting principles usually tell us, if there's not a market, management should use its best judgment. Some management has better judgment than others. And this probably won't surprise you, but there are some people in management who may not always be honest. And if times are not good, they might be influenced to make some opinions about value that are not appropriate. So historic cost has a lot of the advantages to help overcome that. Now, we all know that the value of the dollar changes. The dollar, you might say, is not worth what it used to be. When I went to Penn State as an undergraduate student, which was a long time ago, you could go for an entire academic year. Tuition, room, board, spending money, books, everything, $2,000 a year. Today, it's going to cost you $25,000. Now, one thing that you have is that we're recording it in historic cost, and in our case dollars, for what we ever paid. We wrote a check, or the check came in. But if you're, like, for example, depreciating fixed assets, you might have some assets that you purchased 2 years ago, 3 years ago, if it's a building 40 years ago. And now you're going to go through and record all of this depreciation and amortization, and you're going to match, we talk about matching principle, matching concept, you're going to match today's sales dollars with costs, expenses that were used to generate it, but some of those expenses were incurred 40 years ago, when the dollar was worth more or less than it is today. So historic cost has some advantages and disadvantages. But again, let me read it for you. The advantages are certainty, objectivity, measurability, universality, and the ease of application. So you want to keep those things in mind. But now again, in recent history, meaning all going back 10 years from today, which would be around 2006 or going forward, there's a lot more fair market value accounting than there used to be. The most and easiest example, and probably the most acceptable situation, would be a company recording the marketable securities and investments that are on their balance sheet.